CFA Level I, Overview, Learning Outcomes, and Glossary. AM The Chartered Financial Analyst, CFA, Level I exam is the first step toward earning the globally recognized CFA designation. It focuses on providing candidates with a foundational understanding of key concepts in finance, investment tools, asset valuation, and portfolio management. CFA Level I is organized into 10 topics, 19 study sessions, and multiple learning outcome statements, LOS, designed to test your knowledge, comprehension, and application of financial principles. Learning outcomes of CFA Level I. The CFA Institute defines learning outcome statements, LOS, that detail the specific knowledge and skills candidates are expected to acquire. These outcomes are tested through multiple choice questions on the exam. Below is an overview of the key learning outcomes for CFA Level I. 1. Ethical and professional standards. Understand the CFA Institute Code of Ethics and Standards of Professional Conduct. Apply ethical principles to decision-making in finance and investment management. Analyze scenarios to identify ethical dilemmas and recommend appropriate actions. 2. Quantitative methods. Apply statistical techniques to analyze data. Understand the principles of time value of money, TVM, discounted cash flows, and financial modeling. Use probability theory and hypothesis testing to support investment decisions. 3. Economics. Understand microeconomic and macroeconomic principles, including supply and demand, market structures, and national income. Analyze the effects of fiscal and monetary policies on economic growth and capital markets. Understand international trade and currency exchange rates and their impact on investment decisions. 4. Financial reporting and analysis. Interpret financial statements and ratios for evaluating a company's performance and financial health. Understand the principles of International Financial Reporting Standards, IFRS, and U.S. GAAP. Analyze income statements, balance sheets, and cash flow statements for investment purposes. 5. Corporate issuers, corporate finance. Identify key principles of capital budgeting and cost of capital. Understand corporate governance and its impact on stakeholder relationships. Analyze decisions related to capital structure, dividend policy, and working capital management. 6. Equity investments. Understand the characteristics, valuation, and analysis of equity securities. Analyze industry and company data to make informed equity investment decisions. Understand market efficiency and behavioral finance concepts. 7. Fixed income. Understand the features, risks, and valuation of fixed income securities. Analyze yield spreads, interest rate risk, and credit risk. Apply duration and convexity concepts to assess the sensitivity of bond prices to interest rate changes. 8. Derivatives. Understand the basic types of derivatives, futures, forwards, options, and swaps, and their applications. Analyze pricing and valuation models for derivatives. Identify the risks involved with derivative instruments. 9. Alternative investments. Understand the characteristics of alternative investments, such as real estate, hedge funds, private equity, and commodities. Analyze the role of alternative assets in portfolio diversification. Understand the valuation techniques for alternative investments. 10. Portfolio management and wealth planning. Understand the principles of portfolio theory and asset allocation. Analyze the relationship between risk and return. Apply the principles of diversification and portfolio construction to achieve investment goals. Glossary of key terms. AM The CFA Level I curriculum introduces candidates to a wide range of financial and investment-related terminology. Below is a glossary of key terms from A to M to help candidates grasp fundamental concepts. A. Active management, a strategy where portfolio managers make specific investments with the goal of outperforming a benchmark index. Alpha, a measure of performance that indicates the excess return of an investment relative to a benchmark. Arbitrage, the simultaneous purchase and sale of an asset to profit from price differences in different markets. B. Balance sheet, a financial statement showing a company's assets, liabilities, and equity at a specific point in time. Basis point, BPS, 1/100th of a percentage point, 0.01%, used to measure changes in financial rates like interest rates. Beta, a measure of an asset's sensitivity to overall market movements. C. Capital Asset Pricing Model, CAPM, a model used to determine the expected return of an asset based on its beta and expected market return. Compound interest, interest calculated on the initial principal and also on the accumulated interest from previous periods. Correlation, a statistical measure that describes the relationship between two variables. D. Discount rate, the interest rate used to discount future cash flows to their present value. Diversification, a risk management strategy that involves spreading investments across different asset classes or securities. Duration, a measure of the sensitivity of the price of a bond to changes in interest rates. E. Earnings per share, EPS, a company's net profit divided by the number of outstanding shares of its common stock. Efficient market hypothesis, EMH, the theory that financial markets reflect all available information, making it impossible to consistently achieve higher returns. Equity, the ownership interest in a company, represented by shares of stock. F. Fair value, an estimate of the market value of an asset or liability based on current market conditions. Forward contract, a customized contract between two parties to buy or sell an asset at a specified price on a future date. Fundamental analysis, a method of evaluating a security by examining economic, financial, and other factors. G. GAAP, generally accepted accounting principles, a framework of accounting standards, rules, and procedures used in the U.S. Gross domestic product, GDP, the total value of goods and services produced in a country over a specific period. Growth investing, an investment strategy focusing on companies expected to grow at an above-average rate compared to their industry. H. Hedge, an investment made to reduce the risk of adverse price movements in an asset. Hypothesis testing, a statistical method used to test assumptions or claims about a population parameter. Holding period return, HPR, the total return received from holding an asset over a specific period. I. Intrinsic value, the actual value of an asset based on fundamental analysis, independent of its current market price. Inflation, the rate at which the general level of prices for goods and services rises, eroding purchasing power. Index fund, a type of mutual fund or ETF designed to replicate the performance of a market index. J. Junk bond, a high-yield, high-risk bond rated below investment grade. Joint venture, a business arrangement where two or more parties agree to combine resources for a specific project. K. Kurtosis, a statistical measure that describes the shape of a distribution's tails in relation to its overall shape. Key rate duration, a measure of a bond portfolio's sensitivity to changes in interest rates at a specific maturity point. L. Liquidity, the ease with which an asset can be bought or sold without affecting its price. Leverage, the use of borrowed capital to increase potential returns on an investment. Limit order, an order to buy or sell a security at a specified price or better. M. Macroeconomics, the study of the economy as a whole, focusing on factors like GDP, inflation, and unemployment. Market capitalization, the total value of a company's outstanding shares, calculated by multiplying the share price by the number of shares. Modern portfolio theory, MPT, a theory that emphasizes the benefits of diversification and the trade-off between risk and return. Conclusion. CFA Level I provides a strong foundation for financial professionals, focusing on critical concepts and practical applications. The learning outcomes guide candidates in mastering the essential skills needed for portfolio management, investment analysis, and ethical decision-making. Understanding key terms from the glossary, AM, is crucial for navigating the curriculum and excelling on the exam. By mastering these concepts, candidates take their first crucial step toward becoming a CFA charter holder.
you ain't at the grind.